Swayam Prabha. Digital India. Educated India.
Welcome to this session on the macroeconomic environment. So the macroeconomic environment refers to the overall conditions of an economy captured through broad indicators such as output, employment, inflation, and policy direction. It sets the context in which business operates, government make decisions, and households plan their economic choices. In this session, our focus is on one fundamental concept called gross domestic product. Shortly, we call GDP. GDP measures the total value of goods and services produced within an economy over a specified period. Is the most widely used indicator of economic performance, growth trends, and cross-country comparisons. We will discuss what GDP captures, how it's measured, and what it can and it cannot reveal about the health of an economy. In addition, other key macroeconomic topics such as inflation, interest rates, business cycle, fiscal and monetary policies will be covered in later sessions where they will be examined in greater detail and context. So let's begin by unpacking what GDP really tells us and why it continues to be the central to economic analysis. So you can see that normally when we compare countries between countries and even countries' economic growth over time, we use GDP. We use GDP to measure whether the economy is growing or if growing at what rate. So in this case, the measurement of GDP, that is the main variable that we use in measuring the economic growth. In this case, the methodology used to measure GDP is called national income accounting. Let's begin with a formal definition of GDP. So GDP means value of all the goods and services produced within a country, within the domestic territory in a given period of time, say in a quarter or a year. So when we can get to know about this, the GDP, the total economic activity, the total summary of total economic activity, I am showing you here two economic agents. One is household and the second one is firms. And you know that you have seen in one of the previous session, households are the owners of all the four factors of production: labor, land, capital, and organization. They are the owners of the factors of production. So this is the markets for factors of production, and the firms make use of these factors of production. In return, they will be giving wages, rent, and profit to the income. Finally, it becomes the income for the households. So what you can see that by selling their factors of production, they're giving their land, labor, and capital, employing their factors of production, they get in return, they get the factor income, and we can call it as income. Actually, later on, we are going to say that this is their income. Suppose households, by employing their factors of production, this firm produce, for example, 100 billion of goods and services are produced. Then you know that the total value of goods and services, I'm just writing here G and S, I mean here goods and services. Then you know that some share it will be given in the form of wages. For example, let us make it in three categories. Wages is, for example, 16, and rent is, for example, 15. Then the remaining 25, that becomes profit, right? So this 100 is distributed among these three in three forms: wage, rent, and profit. Actually, interest also should be there, interest income as well. So let us make it this one 10 plus 5. So total for factor income, it goes to the households. So that means when 100 billion is produced here, equivalently you can see that 100 billion of income, factor income is generated. Billion of income has been generated here, right? So then using this income, you know that because firms have already produced goods and services, and using this income, the household, they spend this money and buy goods and services. It becomes revenue for the firms, and in return they give goods and services, and the goods and services are bought. So you know that all this 100 billion again coming here as 100 billion of expenditure that is taken place here. So what we have seen that on one side the total production is for example here the total production is the 100 billion that you can identify here. This is the 100 billion production, and here this is the total income. Total income is here 100 billion is the total income here, 100 billion, and the total expenditure is here, again the total expenditure also 100 billion. So shortly, using this circular flow diagram, what we have seen that in this circular flow, you can see total production, that the total value of goods and services in a given period of time. For example, in our example, this one is 100 billion, and equivalently there is 100 billion of income, and equivalently again there is 100 billion of expenditure. So totally what you can see that total production equal to total income equal to total expenditure in an economy at a given period of time. So at equilibrium, the amount of output produced equals amount of demanded, aggregate supply equal to aggregate demand. So you can see here is that in this case we identified, because this is the total economic activity in this economy, then we measured this economic activity in 3 places in terms of total production, total income and total expenditure. So in that way what we can see that we can use this framework to measure the GDP. So I am showing you when we bring government here and also the foreign sector, what happens. So in the previous figure, we have only shown 2 economic agents. One is firm and the other one is household. And now we have government, additional one more economic agent. Government is in the picture, and also we are bringing the foreign sector into the picture. So what happened that though we said that the total production equal to total income equal to total expenditure, but there can be some leakages because domestic households, what you can see that domestic households, I said that in the previous picture I shown that actually they spend, but here actually what happened that they don't spend all their income on the buying goods and services. Instead they will be saving. Out of 100, suppose their saving is for example 10. So you can see that there is a leakage of 10. And similarly, government collect tax from households and firms. Suppose they collect tax from 70, 10 is the tax. And similarly, we import goods and services from abroad, import for goods from other countries. That means out of our total income, for example, 10 we are giving abroad, we are spending abroad. So all these 3 are leakages. So for example, in the previous picture, I shown that actually 100 total product equal to 100 total income equal to 100 total expenditure. Then what happens that here in this picture you can see that the total product is 100, total income is 100, but total out of this 100 here expenditure, 10 is taken away by government in the form of tax, and 10 is given a saving in the finance market, and 10 is used for financing import. So that means it becomes 70 only. These are the leakages. But though there are leakages are there is actually this coming back to the economy. When government takes tax 110, they'll be spending it back. That means they'll be spending 100 to the economy. And when households, when they save, they will be investing this in the financial system, for example in the banks, but then they will be lending, this financial system institutions will be lending this to the firms and households for buying goods and services for investment purpose. That means investment is nothing but buying of capital goods. And again, when we are importing, at the same time we export as well. So simply when there is 70, this leakage is again filled by in the form of injection, that is 30, that is government spending, investment and export. This will be compensated for the leakages. So simply from this diagram what we are showing that If there are some leakages are there, it can be compensated in the form of injection and on these heads. So coming back to our initial figure, what we saw that in the circular flow, actually this is the circular flow of income, output and expenditure. So in that way, the circular flow is nothing but the economic activity of a country, the summary of economic activities. So in that way, that's the economic activity we can measure the national output or national income or national expenditure. We can identify in 3 places, and that means we can measure it in from 3 methods. One is called product method, that is the total output, identifying or measuring what is the total output or total product in the economy. And second one, we can also identify this one, the GDP, from what is the total factory income in an economy at a given period of time. Or otherwise, we can see what is the total expenditure in an economy at a given period of time. So that means from the expenditure side, we get the total expenditure, then what is the total income generated, and what is the total production of goods and services. So summarily, what we are saying here is that the gross domestic product can be calculated in 3 different ways. So that one is called production method. This is the sum of all values added by all producers of both intermediate and final goods. And then second one is called income method. That is the total income claims generated by the total production of goods and services. And the third one is expenditure method, as the expenditure needed to purchase all final goods and services produced during the period. So before going further, let me make it once again is clear. We can also call it gross domestic product. We can also say that gross domestic income. We can also call it gross domestic expenditure. This one can be replaced by gross domestic, that the product is equal to income equal to expenditure. And one more thing, we are talking about the gross domestic. The gross domestic means whatever goods and services produced, or whatever the income generated, or whatever the expenditure in a domestic, the border, within the domestic area of a country. Whatever, for example, in India, whatever is produced within India, be it by foreigners or Indians, whatever produced within the domestic territory of the country, that is called as gross domestic product, GDP or GDE or GDI, because GDI means gross domestic income or gross domestic expenditure. So let's go one by one, starting with the production approach. So production approach, the production method. Here we use gross domestic product. It shows the current market values of newly produced final goods and services produced in a period, a year, within the economy. So important points to note here is that you need to take a note on the market value and also take a note on newly produced goods and final goods and period and within the economy. So market values, we follow the aggregation rules by multiplying the current price times the quantity of goods 1 plus current price times the quantity of goods 2 and so on. So to explain product method, let us take case of one particular shop, how much they contribute to the GDP in a given period of time. Let's take, for example, because the very definition of GDP as per our approach is product method is the market value of all goods and services produced. So let's take, for example, a shop, coffee day shop. Suppose their total annual revenue is 10 lakhs per year. So can we say that 10 lakh is their GDP contribution? Can we say that? I don't think so, because the reason that, remember, some components of the output produced by them was accounted elsewhere as well. For example, in the coffee production, you know that you need coffee powder, you need milk, you need sugar, you need electricity. Suppose sugar is already accounted in by the sugar factory. Milk is already accounted as a GDP contribution in the dairy firm. Then a coffee powder producing firm. Then when we say that 10 lakh is their GDP contribution, maybe they use all these inputs, for example, of 6 lakhs input they use. Then their contribution is their own effort plus profit, maybe then 4 lakhs. right? So what we need to take here is that the GDP contribution is not this 10 lakh. Instead, we need to take only these 4 lakhs. 4 lakhs only we need to take here, because that is their value addition, because 6 lakhs of input they have used, intermediate product they have used in the production of in generating the revenue of 10 lakhs per year. So in this case, what we can see that the value added by each firm in their production, each firm's contribution to total output is equal to its value added. So in this example, suppose the 10 lakh is the revenue by this shop, and 6 lakh is the inputs, and the 4 lakh is the effort that the labor employed by this firm and the profit generated by this firm. That includes 4 lakhs. That is their value addition. So that is the GDP. So out of this, 10 is not the GDP. GDP contribution is only 4 lakhs. So in that way, how we can calculate this one, you can see that 10 minus the 6 is the intermediate output they use, intermediate goods and services that they use, that we need to subtract. So the value added is the gross value of the firm's output, that is 10 lakhs minus 6 lakhs, then what we are going to get is 4 lakhs here. So it avoids double counting. Suppose if we directly say that the 10 lakhs we take as their GDP contribution, that is actually we are making double counting, because the firm that produce sugar, the firms that produce coffee, the firms that produce milk, they will be adding this value in their revenue. When they are reporting their GDP contribution, they will be reporting this. But then when we are including here, we are double counting. So in order to overcome this, we are actually using the value added method. So final goods, the goods that count as part of the economy's output, that is GDP. So the sum of all the values added produced in an economy is called gross value added. So that is using product method, we are actually calculating the gross value added here. So this is the using another illustrative example, we can explain what is this value added method is all about. Suppose you buy bread from a retail shop, for example, at a 2.75, and you know that this has come through farmer, miller, baker, retailer, and then what is the value addition they made. So we start from farmer. Here we need to take an assumption that out of the blue, they just contributed, they produce wheat worth $0.8. In fact, they take fertilizer, pesticides and all. For the time being, just for a starting point, we assume that that is their own contribution. Then you know that when the miller buys from them by giving 0.8, they add, after grinding, making it a wheat flour, they sell it at 1.8. So their added value is 1. Then the baker buy it from 1.8 from the miller, and they sell it at 2.5, then they add a value 0.7. And then the retailer take it from the baker at 2.5 and sell at 2.75, then make a income of 0.25. So you can see that in this example, the last column you interpret, when you sum it, the farmer's value addition is 0.8, miller's contribution is 1, baker contribution is 0.7, and the retailer contribution is 0.25. So at the end, when you add this one, you are going to get the total value addition, you are going to get 2.75. Yeah, so this one, the total is going to be 2.75 is the total value of this particular good. And instead of directly going and measuring it from the retailer, we need to see what is the value added by each economic agent in this process. And the second method is called income method. Here, by adding together all types of factory incomes generated in the production process, such as wages and salaries, bonuses, that the labor income, and other components payable to employees, plus interest income, profits. You can see wages, rent, interest, and profit, plus operating surplus. Operating surplus means mainly by firms. They won't distribute all the profit to the shareholders. They keep some of the profit as undistributed profit to meet the operation needs of the firm, to meet unforeseen contingencies of the firm. So, but that actually belong to the employee, belong to the shareholder. So that should be considered as part of income. So according to the income method, when we aggregate all the factor income, including wage, rent, interest, and profit, we are going to get the total income, and that is the GDP measured through the income method. Then the last third method is called expenditure method. The final uses of the output are the sum of final consumption, gross capital formation, and government spending. So when the income has been generated, total the goods and services have been produced, then the equivalent factor income has been generated, then how this has been spent. So you know that the total income when you get your total income equal to C, the total consumption and saving. From household perspective, your total income is going to be consumption plus saving. The saving is eventually invested in the financial institutions, and that they will be giving it as loans and advances to the firms. Then it will become investment. So that means total expenditure, investment is nothing but a buying of capital goods. So then also you also pay some amount of your income to the government as tax. So then you know that T is going to be equal to government expenditure. So at the end you can see that Y is equal to C plus S is already become I, investment, and T already become G. So that means total income you are spending in consumption of goods and services, and the investment, that is expenditure on capital goods, then government expenditure, plus you will be we'll be buying, exporting goods and services, at the same time importing as well. Suppose export is for example 10, import is for example 8, then the net export is 2. That means the total income that we are actually having a surplus here. So the total expenditure side of the economy in an open economy is C plus I plus G plus X minus M. So C is the household consumption expenditure, I is the investment in fixed capital, and G is government consumption, X export, M is import. Suppose GDP through product method, and suppose we got GDP through product method is 100. Then take this example, the total expenditure in the country is for example 85, and the investment is 10, government expenditure is 10, and finally we are going to see the total expenditure. We are going to see that actually if the foreign sector is not in the picture, total expenditure is like that the household expenditure C, firm's expenditure I, government expenditure is G. And using this approach, suppose we get 105, but using the income method and the product method, suppose we got the GDP 100. That means actual GDP is only 100. So we are consuming here, suppose in this example, plus 5, not from our GDP, that but from import, which is not part of the GDP, because GDP means the goods and services produced within the domestic area, domestic territory of a country. So in this case, in order to get, if we want to calculate the expenditure side of the GDP, we need to subtract X minus M. So in this case, you know that export is 10 and import is 15, then minus 5 we need to subtract. Suppose this one is 10 and this one is 15, and plugging all this value here, 85 plus 10 plus government expenditure also 10, this one, all this, then you are going to get 105 minus 5. Right, so then you will be getting 100 as the GDP. So using this approach, the expenditure method, you can calculate GDP in this way. That means calculating GDP using consumption, investment, government expenditure plus export minus import. So to summarize this one, the GDP measurement is the example which I have given here. From this example, you can see that that is the total expenditure calculated in using this method get us the GDP for this country. So then you can see that practically in your mind there will be a question comes. Suppose our income is only 100, but the GDP, when we see the total expenditure here is 105. So if value of export is less than import, then we must borrow from abroad or use our wealth accumulated over the years, like selling gold, to finance this expenditure. So to summarize, in this section, we focused on how we measure the performance of the overall economy using GDP. So we began with the idea that GDP represents the total market value of newly produced final goods and services within the country during a specific period. And in order to explain this concept, we use the circular flow diagram where there are three economic agents. One is households, firms, and government. Then we further connected to the foreign sector. So we also looked at the three main approaches in calculating the GDP. One is called the production method, value-added method, and the second one is called the income method, and the third one is called the expenditure methods. So each method provides the different lens of the same economic activity, and in principle they should all yield the same GDP figure. So this foundational understanding of GDP set the stage for future discussions on related topics like inflation, business cycle, fiscal, and monetary policies. Thank you for watching this video, and see you in the next session. Thank you.